The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and welcome to the first of my webinars for this year. My name is Matt Slater, and I'm the lawyer's accountant from FWO Chartered Accountants. Today we're going to be talking about the topic of law firm funding, and I know that will be a topic that's quite passionate for all of you and quite topical, particularly given the challenges over the last few years in the legal industry, particularly around cash flow funding and also around the the challenges with.
Welcome to GoToWebinar, Web Events Made Easy.
Sorry, Matt, I can't hear you. Hello, everybody. Can you hear me now? Hopefully, I've just had a few comments come through that the sound had dropped out, and if you could somebody just let me know that the sound is now connected, that'd be great. So I apologise for that. We've had a little bit of a false start. Thank you, Angie, for letting me know you can hear me. Usually, I just do this and speak into the microphone and on my computer, but for some reason it hasn't let me, so I've just had to dial into the phone. So apologies for the false start there, but just quickly to recap, for those of you who've joined us for the first time today, welcome. We've had a change of our branding. We're now known as FWO Chartered Accountants, same firm doing the same thing with the same people and the same focus. Today we're going to be talking about law firm funding, and in doing so, we're going to be focusing on what your debt strategy is for your firm, and we're also going to be focusing on the impact that can have on your business plan from a cash flow perspective. So we may as well get into that. First of all, why? Why is this such a relevant topic? A lot of firms struggle with cash flow. I hear comments regularly that cash is tight. So one main reason to look at your funding strategies within your firm is to focus on one, your normal activities around WIP and debtors management, but two, you should also be looking at your funding strategy so that you can free up your firm's cash flow. Another reason looking at funding strategies in firms is often around succession, and often this is one of the reasons why people start looking at their funding, because they often need to find a lump of cash to pay out a retiring or exiting principal, and in doing so, they take a look at their entire funding for the firm and work out what's possible. Another reason is expansion. Often firms are looking to grow their businesses, grow their work in progress. They look at acquisitions, mergers, and for all these reasons, they need to stop and assess what their funding strategy is and what it needs to be. There's really only two ways that a firm can be funded, and that's either via equity and or via debt. Equity is basically funding the practice via retention of profits, where debt is getting that funded from an external source, and often a bank. But I think that what most firms don't really recognise is the amount of cash that gets tied up from an equity-funded business is quite significant. Quite significant, not necessarily just from the perspective of the value of it, but also from the perspective of the pressures that it puts on. So in most firms, they've got very standard balance sheets. The balance sheet will comprise of office equipment. It'll also include some unbilled disbursements. It'll include work in progress, and it'll include debtors. So that's very much a standard balance sheet for a law firm. But what usually happens over time in law firms is that these assets just continue to grow and to grow and to grow. And by growing, basically what they have to do is they have to do that via a retention of profits. And the cash flows that have tied up in these retained profits becomes quite significant, and eventually get to a size that can impede the firm. So to give you a bit of a picture of that, let's use an example of a firm that might be equity funded. That might have, say, $180,000 of office equipment. They might have unbilled disbursements of $75,000, work in progress of $1 million, and debtors of $130,000. So, this might be a firm that has a reasonable portion of, say, personal injuries work that they do, but also has a mixture of other work that they do for clients, maybe commercial or estate, or maybe some other litigation work. But all in all, this firm has got tangible assets that it's funded over time of in excess of $1 million. And the value of that $1.15 million has got to be funded by that business out of cash that hasn't been drawn out of the business. So equity funding is basically equal to the undrawn profits after tax. And quite often in firms, that undrawn profit after tax is profit that's at 53.5%, being that on the profits that are earned, tax is levied at 46.5%. So if you really want to see the impact of equity funding a firm, you've really got to go back and have a look at how many years of those undrawn profits have we had to reinvest back in the business just to get it to the point where we've got it now. So let's take a scenario and take a firm that might have a couple of $1 million of revenue. Overall, its costs, including partners' salaries, are 80% of the fees. So it's making a net profit after partners' salaries of $400,000. It pays tax at 46.5%. So in one particular year, its after-tax profit is $214,000. Now, it's important to understand a couple of pieces in here. The first piece is that when you look at work in progress and debtors, the work in progress and debtors you have is a function of what the revenue is that's billed or not billed. And in generating that revenue that's billed or not billed, being WIP, you've had to incur costs to create that revenue. And in this example, those costs are representing 80% of the value of those fees. So effectively over time, as that WIP and debtors grows, 80% of the value in this example are costs that you've physically incurred in generating that WIP and debtors. Now, those amounts are significant when you look at it. And in this example, if we've got $1.15 million of WIP and debtors, those costs from a work in progress perspective, which were $1 million, are $800,000 of costs. So if you look at that, to equity fund a $1.15 million lockup of tangible assets, that's the equivalent of 5.42 years of undrawn profits after tax. So that means you've got 5.42 years of cash that's had to be funded after paying tax before you can even draw any of those profits out that have been reinvested. Now, that's a long period of time. You know, a year's a long time in business, let alone 5.42 times. This scenario could be a little bit different if you've funded that via an incorporated legal practice because your tax rate's only 30%. But in saying that, you're still going to have a significant number of years of undrawn profits that you're still going to have invested in that business. So the impact of that 5.42 years of undrawn profits, the impact that has on a business is it produces a significant amount of cash flow pressure. And that cash flow pressure is both from a personal and a business perspective. That cash flow pressure is produced because you haven't been able to fund those drawings out of the business. So often we see firms where the principals in firms have got significant personal debt. That significant personal debt is tied up in home loans and in credit cards that are blown out. But also the personal pressure that it produces is, just pressure on lifestyle as well. Working hard, apparently producing all of these profits, but not being able to enjoy the rewards. And from a business perspective, businesses that have got their cash flows that are tied up in their assets, and which are really their current assets, those assets that fund their cash flow. What it does, it puts continuous pressure on that business. Pressure from the point of view of almost living day to day. We've got to get that cash in this week to make that wages bill. We've got to get this cash in by this time to get the rent paid. We've got to get this cash in to pay the bills, let alone before we're even talking about partners' draws. So with that constant pressure, what it does, it produces a significant amount of growth inhibitors, because the firm is so caught up in focusing on daily cash flow pressures, it's not focused on what it needs to do to fund its growth. And ultimately, you've got to fund your growth over time, be it via an increase in your tangible assets, or or if you're looking to acquire, you've got to get that cash flow from somewhere. So I just want to run a very quick poll before we continue on. So just give us an outline of what best describes your funding strategy in your firm. So if you'll see on your screens three options to choose from. Equity funding, so you've got none or you've got minimal debt, or you've got debt that's supported by personal assets in your business, or you've got debt that's supported by business assets. So if you could just tick off which one of those is most applicable to you. We'll just give that a few more seconds. We've got about 60% that have voted now, and so thank you very much. We'll close that, and basically what we're seeing is that of the firms, there's about 23% are equity funded, or 50% are debt funded by personal assets, with about 27% supported by business assets, which is pretty normal. So we usually see within firms a significant portion of those firms have been funded from personal activity, be it debt or be it just retention of profit. And often where there's debt supported by personal assets, those firms also have got a significant amount of equity that's tied up in their tangible assets as well. So thank you very much for that. So the idea of today is to really talk about, what you can do about this, what options are available for you. And I've invited Brendan Burrows along from Bank of Queensland, and I'll introduce you to Brendan very shortly. But the first thing I'd like to point out that there's a myth that's out there that law firms have no value. I think that law firms are the third oldest profession in the world. The accountants are the second oldest, and we were put in place to count the money, and then the lawyers were put in place to keep the first profession operating. So we've got, as accountants and as lawyers, we've got very, very old, long-established businesses, very credible businesses. And whilst it never ceases to amaze me that lawyers have the view that their practices aren't worth anything, when they have a revenue stream that is almost guaranteed to continue. Yeah, you've got to still run your business. Yeah, you've still got to focus on action plans to drive and produce profitability. But you've got businesses that are strong and viable and in effect produce revenue that recurs either via existing clients or from new clients. So what banks look at is they basically look at the cash flow, and that's very much a bankable asset. And banks don't really have many industries that they focus on where they strongly value those cash flows. So when you look at value, apart from the value from an equity sale, you've got a value that is actually placed on your business in terms of your ability to debt fund it. So how do banks make money? There's only, the only way they make money is by lending money. If they're not lending money, they're not going to be making any money. But when a bank looks at whether or not they will support a business, they look at two overriding criteria. And the first one is the security that's offered, and the second one is that there's an ability to service the debt. So if you're a bank that's focusing on, if you're a firm that's focusing on developing a debt strategy for your business, you've really got to consider both of those options. So at this point in time, I'd like to introduce you to Brendan Burrows from BOQ. Brendan is a business manager here in Brisbane, and I've worked with Brendan over many years in working with legal firms in terms of supporting them with their debt strategies within their firms. So welcome, Brendan. Are you still there, Brendan? I'm still having sound problems and must apologise. Brendan, if you could dial back in and let me know if you're present, that'd be great. Sorry, guys, I've got to apologise. We've got some serious sound problems in this webinar today, and it appears that Brendan's dropped off the line. But Brendan, if you're still there and you can dial back in, just let me know. So what I've put up here for you is the legal firm lending policy for the Bank of Queensland, and with their lending policy, the BOQ will actually lend up to 50%. 50%.
Hello, Matt. I'm back on.
Oh, g'day, mate. How are you?
Sorry, I had a technical issue there.
That's right. No, we've been having some sort of sound problems all day. So look, thanks for joining us. So Brendan, first of all, what I'd like to open up with is if you could just give us your view and BOQ's view in terms of your attitude towards law firms and how you see them as a valuable bank customer.
Thanks, Matt. Well, firstly, I'd like to point out that Bank of Queensland highly value legal firms. Legal firms are only one of three industries that we will really lend against gross fees. Legal firms, accountants, and some medical practitioners. So in saying that, we do have a fond view of legal firms. There's not many other banks. In fact, I think we're one of the few that will do this, lend up to 50% against gross fees. So we like them.
Excellent. So could you just run us through, I've got up on the screen that people should be able to see, is I've just got a very, very quick overview of your lending policy, but there's more detail to this. But from the work that we've done, I've seen that these are the key criteria that we really need to hone in on when we're, as advisors to firms, when we're looking at whether or not there's an ability for a firm like yours, Brendan, to fund these legal firms. So you just run through that policy for us.
Yep. I'll just start by qualifying that we will still look at all firms, even if something doesn't fit with the policy 100%, that we do have flexibility and scope, to negotiate. We might not always get to where we need to be, but we certainly will go outside the boundaries for the right type of customers. I will say that it is always a preference that if we are taking some security over residential as well, it's not 100% necessary, but it does strengthen the entire transaction. In saying that, in terms of some of the performance standards that we look for, greater than 3 times interest cover, we're looking at the profitability of the business, and we're looking at efficiency, what work in progress as a ratio to your total income, the profitability as a percentage of total income, and interest cover, obviously 3 times. They're the type of things that we look at. We do like if we are funding against the gross fees, we do like to have an amortization plan in place, so it's not ongoing forever. But we will look at vehicles, we will look at other equipment finance for fit-outs. They're the type of things that we'll take into consideration. We will take charge over life insurance and so forth.
So yeah, Brendan, that's pretty indicative of the experience that I've had with you, and we've had different deals that have been pretty straightforward in terms of your policies, and we've had other deals that have gone beyond your lending criteria. But in saying that, the view of BOQ is that, in my experience, is that you actually look at it from the business's perspective and understand that with legal firms, they're all very, very different. So if we were just to go back to our example that I put forward before, using BOQ's policy as an example, because there was $2 million worth of fees, and looking at the profitability of the firm and the value of WIP and debtors and so on, then basically what that would allow is an additional up to $1 million of debt to potentially be utilised by that firm in one way or another. So,
correct.
So, Brendan, what would you say would be probably the number one criteria that the BOQ looks at when it's looking at a firm?
Look, I think there's a lot that, and there's some are probably equal to others, but we will look at the first thing we'll look at is the gross fees. The absolute first thing we'll look at is the gross fees. We do recognise there's peaks and troughs for different types of legal firms, and sometimes that needs to be balanced out and can put a significant strain on the short term on cash flow, which happens to certain firms depending on what type of law they are practicing. But that's really the first indicator. We also look at the character of the firm, how long it's been in existence for, those basic type of ratios that we spoke about. Really the strength of the business. It doesn't take long to ascertain how strong, and a lot of firms we see do have strong cash flows. So.
Yeah, and it's, as I said before, that's it's that hidden gold mine. It's that hidden value, the cash flows that are really locked up in legal firms. So, one of the things that you really need to have a look at when you're considering the debt structure of your firm is the cash flow. But also you've got to have a look at, what are those other opportunities that exist within your firm. Often when I go in and I review a firm, I see that there are significant opportunities that present themselves in terms of structure, not only of debt but of the business. I see that there's opportunities to restructure personal debt, I suppose to stop the pain of those high home loans that have been in place whilst the practice has funded significant growth in their working capital assets. So there's many different reasons to have a look at your cash flow funding in your business. So if you were, and this is just putting this out to all the participants we got on the line today, but if you were looking at some refinancing for your business, what would you use your debt for? Would it be around restructuring equity to an ILP? An example of a recent transaction that we've worked on with a legal firm client. We had the issue of succession and used that as an opportunity to restructure the business into a company. And at the same time, we were able then to really consider what the future debt funding needs of that new ILP would be, but also to have a look at what the debt funding strategy is for the principals individually. And in doing so, very much able to get some really good gains for that particular firm in that strategy. We often see that opportunity to retire some non-deductible personal debt. I see in a lot of firms that, particularly where they've been operating as partnerships, those partnerships have built up significant partners' capital accounts, basically equal to their undrawn profits. And at the same time, what they've done is they've got these assets, these loans sitting outside, which are non-deductible home loans. And most firms don't know that you can actually structure your debt or restructure your debt to allow those capital accounts to be paid out and obtain tax deductibility on that debt. Often you need to look at your debt strategy when you're looking at funding a partner exit. But importantly, you also look at funding a partner entry. So, Brendan, I note that in BOQ's lending policy, it lists out a number of reasons why you'd be looking at funding a firm, and one of those is partner entry. So, can you tell us a little bit more about the bank's position on looking at funding new partners into practices?
That's certainly one of the more common things that comes up. purchase of practice or share in the practice. We potentially can even look at establishment of practices where a partner may be retaining or purchasing an existing client base from previous employment. Working capital, obviously, overdrafts, items of capital expense nature, fit outs and so forth, and capital contribution loans, where I think one of the important things to take out is that a lot of people have a lot of equity tied up, and this potentially is a way to unlock some of that. So if that sort of makes sense.
Yeah, absolutely. You also see it for purchasing new practices, so practices that are looking to, as you said there, to buy client lists from old firms, funding growth, and that growth can be either via acquisition of add-on practices or funding growth strategies within the firm in terms of new revenue, and also to free up current cash flow. So if you looked at your firm and you had a $1.15 million locked up in capital, and you had a facility provided of say $600,000, it doesn't mean you actually have to go and withdraw that. But what it does, it can free up that cash flow to take the pressure off and change the behaviours of the business to really start supporting you around that growth and the other activities that you implement. So at this time, I'd like to maybe open up to see if there are any questions that anybody would like to ask of either Brendan or myself. We have just a matter of typing that in, and if you've got any questions, just pop them down, and if we can't get to them today, then we'll certainly touch base with you and open a dialogue about them post the webinar. So any questions? Okay, so no questions at this stage, that's fine. So just to wrap up, I really would like to just thank you, Brendan, for coming along today. Hopefully our listeners have had an opportunity to just gain a bit more of an insight into what's possible out there in terms of developing debt strategies within businesses. And my observation of firms is that they don't consider debt funding within their businesses enough, and in considering that, they need to really look at what their longer term strategies are and how best to utilise the support of banks to help them achieve their goals. So just as I usually do, what I'd like to offer out there to all of you who have registered and listened in today, the first 15 to email me today at matt@fwo.net.au. We'll schedule in a free one-on-one funding review, and what we'll do in that is just take a look at the position of your firm. What's your financial position? What's your current debt? How is it funded? Have a look at what your current structure is, and just have some conversations with you around what's actually possible. So we'll do that in a one-on-one online basis. So all you need to do is to drop me that email, and we'll get that scheduled in over the next couple of weeks, and only takes about 45 minutes, and we'll do that one-on-one. Another little bit of advertising. You may have received over recent times some information from me on a couple of new initiatives we're launching this year. First one is the FWO Legal Firm membership. Basically what that is, it's just a free membership. We're producing a bi-monthly exclusive e-zine for members of the Legal Firm membership group. That will just have some really pertinent articles written specifically for law firms about numbers of different topics, some of which are covered on webinars and other content. They'll also get access to early bird registrations for webinars, personalised invitations to our workshops. If they like, a free one-on-one profit and cash flow improvement review for the firm, and unlimited telephone and email contact with me at any time. just ask me any questions about anything. No obligation. We're also launching over the next month the FWO Growth Club, and this is an initiative that's designed to help and support firms through developing strategies around profit and cash flow improvements, where I'll be putting together groups of 10 like-minded firms where we'll meet for a full day every quarter, and we'll work through a fixed and structured program over 12 months designed at improving and developing strategies to grow profit and cash flows within the firm. Prior to that, we'll be undertaking on-site profit and cash flow reviews, analyses, and providing recommendations to that firm as to what they need to do to get that firm back on track, or to make improvements around driving improvements in profit and cash flow. And we'll keep those firms, all your firms, accountable for that on the way through that 12-month program. But more importantly, driving support to and from other members of firms within your Growth Club group. So if you're, really encourage everybody to at least take up the FWA Legal Firm membership. You just need to visit financiallywellorganised.com, follow the links to the registration. It's pretty painless. And then also there's a link there for the FWO Growth Club. At this point, we're just taking some expressions of interest, so we'll be in touch later on that. So once again, please take me up on my offer in terms of doing your funding review. It's just always good to have a new set of eyes just looking at your business and to see what's possible. Brendan, thanks again for joining us today. We really appreciate your input, and thanks, mate. And for everybody, thanks again for your support with these webinars. The feedback I get is great, so we're going to continue doing them every month. So watch out for the information that we'll put out for next month's webinar. So thank you again. We'll send a recording of this webinar to you all some stage either late this afternoon or tomorrow. But thanks again for participating, and talk to you all soon. Thank you.